Welcome to our financial broadcast. Today we delve into the turbulent first year of Donald Trump's second presidential term, which began on January the 20th, 2025. While some of his economic plans initially boosted United States stock markets, a brewing dispute over Greenland is now injecting fresh instability into global affairs. Looking back at his inauguration, sentiment on the Frankfurt trading floor was mixed. One observer noted Trump's business-friendly stance, which resonated positively with the stock markets. Another pointed out that while there wasn't a broad market upswing, sectors like defense, technology, and banking performed exceptionally well. Despite negative news, markets seemed to defy gravity, reaching new highs. However, some analysts believed the tariffs should have had a far greater impact on stock performance. Yet, the numbers tell a clearer story. United States stock markets delivered solid returns in Trump's first year. The S&P 500 index saw a 17% gain, an above-average performance. Although it didn't rise as sharply as some European indices like the DAX or those in Spain, Greece, Poland, Austria, or the Czech Republic, dismissing United States markets, as many experts had advised in the spring, proved to be a mistake, albeit a rationally understandable one. Indeed, as early as November 2024, with Donald Trump's election victory, stock markets began to surge. The S&P 500 index effortlessly surpassed the 6,000-point mark. By February 2025, markets primarily moved in one direction, upward. This was fueled not only by the ongoing artificial intelligence boom, which started in 2022, but also by Trump's appealing campaign promises: lower taxes for businesses and consumers, less regulation, and increased economic growth. Add to that a strong state, reduced bureaucracy, and prosperity for all. In short, America first, and aiming to be great again. This message resonated with many investors who believed the United States economic upswing would continue, United States companies would earn well, and United States stock markets would rise as usual. Initially, Trump's protectionist trade policies, particularly tariffs on imports aimed at protecting and developing domestic industries like automotive and mechanical engineering, were largely underestimated. Many believed the impact wouldn't be severe. Similarly, plans or announcements that the United States intended to seize the Panama Canal and resource-rich regions like Greenland were not taken seriously. For a time, trading screens were green, with overflowing profits in the high-tech and financial sectors, and the cryptocurrency market followed suit. Investors were content. However, many were unwilling to acknowledge that tariffs would come at a cost, one that Americans themselves would bear. Economists had warned from the outset. Tariffs would drive inflation, necessitating interest rate hikes. This was not what the United States president wanted to hear, and he ignored it. When Trump communicated the tariffs more concretely in February 2025, stock markets dipped for the first time. The second dip occurred on April 2nd, with the proclamation of Economic Liberation Day. Trump had antagonized half the world, imposing tariffs on many countries, including China, with rates sometimes reaching up to 144%. A trade war with China began, far surpassing the escalation of 2017 in both rhetoric and billions in financial burdens. The consequences quickly became apparent for both companies and investors. Economic damage from tariffs, for instance, to the German automotive industry, and from export restrictions on United States, made high tech, which severely impacted China's chip sector. Additionally, the dollar, the world's leading currency, began to fall. This, combined with fears of rising interest rates, led many investors to abandon United States stocks. They increasingly preferred investing in Europe, particularly Germany, partly due to the new German government's promise of billions in debt-financed investments. All in all, Trump's protectionist policies cost United States stock markets billions. The S&P 500 index fell by more than 10% in the spring. The first 100 trading days under the Trump administration were the second worst since President Nixon. This was not what voters or investors had envisioned. Simultaneously, something the president hadn't anticipated occurred. Bond market prices crashed and yields soared. 10-year United States Treasury bonds, which had been below 4%, suddenly approached 5%. This meant that to borrow new money, the United States had to pay higher interest rates to its creditors, a difficult situation for strained public coffers. Investors questioned, can the United States afford this long term? Do we want to finance this indefinitely? The answer to both was no. And so the president backtracked. After maximal demands, he concluded tariff agreements with better conditions. Trump always chickens out, became a common saying. The stock markets then recovered swiftly and spectacularly. In the second half of the year, United States markets performed better than the DAX. United States companies, particularly in the financial and technology sectors, increased their profits above average. The United States economy grew and confidence returned. The question now was how long this would last. Recently, the world has been reminded once again, Make America Great Again may have initially benefited the United States economy and its capital markets, but it is increasingly clear that the United States president prioritizes winning, regardless of losses, friends, or partners. The renewed tariff threat this past weekend against all countries unwilling to support or accept Trump's annexation of Greenland is another indicator of his arbitrariness. Just a few months ago, the European Union ducked and neither imposed retaliatory tariffs nor otherwise resisted. That fearful indecision now seems to be shifting. The European Union is considering loading its trade policy bazooka. This means counter tariffs are conceivable, even if they harm its own economy, consumers, and market. Furthermore, the European Union could impose certain taxes exclusively on United States companies, for instance, on software and technology firms, and exclude them from public contracts. From the European Union's perspective, the positive aspect is that an absolute majority is not required for such measures. It would also be unlikely, as some countries are not affected by the threats and therefore do not want to jeopardize relations with the United States. A simple majority suffices. A clear, thus far and no further is therefore possible, aiming to restore economic relations on an equal footing. The bazooka is not yet deployed or loaded, but it remains a viable option. Another factor of uncertainty is the Trump administration's attempt to influence the Federal Reserve. This was largely unexpected. If Trump had his way, Federal Reserve Chair Jerome Powell should lower interest rates to stimulate the economy. However, with rising inflation and weak labor market data, the Federal Reserve lacks the mandate to do so. It must not. The independence of a central bank is indispensable in democracies and strong economies. Trump is now pursuing legal action against Powell. And Powell's presumed successor, starting in May, Kevin Hassett, is known to favor interest rate cuts. He currently serves as the director of the National Economic Council, making him a key advisor to the president. However, a Federal Reserve chair who succumbs to Trump's pressure could shake confidence in United States financial policy. The dollar would fall, government bond yields would explode, and the stock market would come under pressure. Who would lend money to the United States if its financial policy is no longer reliable? This entire situation is reminiscent of 1972. At that time, United States President Richard Nixon also deliberately urged Federal Reserve Chair Arthur Burns to lower interest rates. The Federal Reserve initially resisted but eventually complied. What had to happen, happened. Inflation surged to over 9% in 1973 and more than 12% in 1974. The stock market collapsed. In 1973, the United States economy was in recession, the oil crisis exacerbated the problems, and unemployment spread. Today, this is known as the Nixon effect. Of course, the past is not directly transferable to the present. Comparisons always have their limitations. But the danger of an economic crisis is present. The bond market has already reacted more sensitively and foresightfully than the majority of investors in the stock market. For 2026, many analysts are optimistic. The S&P 500 index could rise to 8,000 points. Additionally, the announced tax cuts are expected to take effect. This partially offsets inflation, which, according to calculations by the think tank, the Budget Lab, is projected to cost United States households an average of 1,700 United States dollars per year. Since United States consumption is a strong economic factor, this is good news. However, the latest developments show that the tariff issue is not resolved and can flare up repeatedly, causing damage. This is because arbitrariness has become a political style. Analysts also predict that gold could reach the $5,000 mark. Since the precious metal is a crisis currency, this is not a good sign. And given that the United States government is stirring up sentiment and economies between Greenland, Venezuela, and Iran, China, and Europe, caution remains advised. On Tuesday, United States markets will reopen after the Martin Luther King Day holiday. The negative signs from Europe, Asia, and Latin America could then continue in New York. Uncertainty once again defines trading, with billions in earnings at stake. It's not just the stock markets that are on their knees. The United States dollar is also falling. At some point, every limit is crossed and all trust is exhausted. The question is how quickly the United States government approaches this tipping point, or whether it will once again be said, Trump always chickens out. Trump eventually backs down. Last year, that was a frequently quoted phrase on the stock exchange and an attitude that shaped market prices. Stay tuned for more updates on this developing story. This video was generated using artificial intelligence. Thanks for watching. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to our channel for more updates. See you next time.